Good afternoon, ladies and gentlemen. It is June 1st. We just got through the month of May, which happened to be one of the best months of May that we've seen dating to the late 90s. And during this time, sentiment, according to the sentiment indicator from Goldman Sachs, still at very, very depressed levels. In today's Stock Market Brief show, we're going to try to prepare for this month ahead. We're going to give you some big picture charts, things that we've went over in the past, give you some updates there. We're going to go over some intermarket assets. We're going to be diving into expected moves, give you the monthly look for the S&P 500. We'll give you weekly and daily there too as well. I'm going to go over the current state of market conditions, update you on some of the signal charts, and then also hop into some of crypto. And I added one other section in today's video called ETFs to watch. These are some of the ETFs. Now, I'm not recommending specifically these ETFs, but when we start going over these charts, it may be worth to look into the holdings of these ETFs because the charts themselves are setting up and can produce some good opportunities in this month, potentially the next one as well. As always, these episodes are brought to you by my partners, Interactive Brokers. So if you haven't checked them out, make sure to do so. They have a whole host of tools for free, including various courses from beginner to advanced. And then a big shout out to all my patrons that continue to show up and support for $9 a month, or you can pay annually and give even a bigger discount. You get access to a whole host of benefits, including everything, by the way, is posted in my Discord server. So once you sign up here, you sync your Discord, then you get access to all types of things, including the query channel, which allows you to type in multiple commands to get all types of different pieces of data and charts, all from Trading Ticks. Let's get into today's episode. All right, people, welcome back to the show. We got about 50 pages to go through, so I'm going to go through these fairly quickly and give my thoughts as we go. We talked about this one just at the beginning, how this was the best May that we've seen since the early 90s, so 30-something years here, quite impressive. And this is during the back of having sentiment still pretty depressed levels. Now, the way that I see this is telling me simply this: when sentiment's low, it can mean one, things are very bearish, or uncertainty is really high. And I think that that's more the way to look at this when sentiment's low. I think it's just because the level of uncertainty out there, given the context of the administration, the left and right punches that we're getting via tariff tweets, and the volatility that it's has been bringing into the market. So I think that that's where that uncertainty is coming from. The 30-year real rate, you can see, is also at levels that we haven't seen since the great financial crisis, which is putting, fear into the minds of many investors and traders, rightfully so, because it's been a monster run up here. Now, we are moving into June. And typically June has a seasonality where the VIX spikes more towards the beginning of that. Now, this is based off of the last 5 years. You can go back 20 years. There's typically some volatility uptick in the beginning of June. And this type of behavior doesn't necessarily mean, oh, we're going to crash back down. But I am still kind of going back to what we said on prior videos and back in May, where I said the next pain trade, I believe, is the shakeout. This is where people start to have very, very strong opinions, but yet the market's not going anywhere. It goes a big up day, then it comes a big down day, and everyone's kind of celebrating both sides. But ultimately what's happening here is we're going sideways and we're chopping around before ultimately breaking into a direction that leaves people behind. Whether that's up or down, I'm not too sure yet. I'm leaning more bullish, as I usually do, and I'll show you some of those charts, but I'm just making you more aware that I believe that this is the current trade that's taking place right now, the shakeout. Now, ultimately, if we take a look at global money supply, this is the back of everything here. This is, one way to look at, an important way to look at liquidity. And when you have an increasing money supply, there's liquidity coming in, which is supportive to the markets. And if you take a look at global money supply, that white line right here, you do see this increasing, and it's acting as somewhat of a floor or support for these current markets. So as of right now, as long as the money supply here is increasing, this could be, the liquidity that market needs to continue to consolidate and move higher going further. Now, another chart and thing that we shared and we've been sharing is this S&P 500 monthly chart. So each candle represents 1 month of data. You can see here we just finished this month over here. It's obviously kind of small. We went through a 23% correction. And the last time I shared this, I believe I was sharing it because I was seeing a lot of analog charts, meaning that the current sell-off right here, people were saying it looks like 1929, or it looks like 2022, or it looks like 2011. And I was saying, okay, well, take a look over here. No one's really said 2000, right? Or the late 1990s. And what happened in the 1990s was a very similar thing. We saw a nice big run up, right? But nice big run up, boom, we saw a 23% drawdown. And then we came back to a massive rally to new highs. And this was during the same time where we had this inverted yield curve, the 10-year, 3-month, and it began to steepen, ultimately having the Federal Reserve start to cut rates as well. And it led to the popping of this bubble here known as the dot-com bust. You can see also over here, we saw this inverted yield curve. It started to steepen. We started cutting rates aggressively, right, to ease up on the price action that's been going down, right? The backstop over here in 2009 was we brought rates to zero, and it, brought the markets to all-time highs. And then you could see over here, same situation, but this happened to be the pandemic. A lot of people call this more of a one-off situation, but still we had the rate slammed, we uninverted, right? And we went through this pretty steep correction. And why I'm bringing this up now is because we're in the cutting cycle of rates right now, but it's slowing down, right? This year we were pricing in four rate cuts, a total of 4 rates cuts, and now the market's pricing in, they 95% probability we're going to keep them where they're at here in June and July, and then they're looking at, which is still not even that big of a probability of a rate cut in September, but you can see 1 rate cut here, and then into the end of the year, 2 rate cuts. So that could be, 50 basis points of cuts, which means what? It means that this can maybe potentially go up, but this is what's going to drop just a little bit. So we're not going into this full-blown kind of push to have rates lower right now. And if this is going to be some sort of similar situation, as to this, I think you got to be at least open-minded for the possibility for the markets to kind of chug along higher and perhaps maybe into 2026, 2027, this area year, maybe perhaps, things start to unwind a little bit more. That's all speculation and narrative. It's still important to understand that, the context of what we've seen and how we hit new highs and how even in 2007, 2008, right? This time's different, right? Over here, this time's different. Well, it happened to not be different multiple times, right? As far as the volatility and the uptick in market bearish sentiment. If we look into next week, what do we have going on? Monday, we get some ISM data. Tuesday, we get JOLTS data. Wednesday, we get ISM services PMI. And then Friday, we get some jobs data here too as well, which these are considered market moving events. So if you are trading intraday, it's important to have these on your calendar, know when they're about to hit the tape, because you can see volatility increase the moment that these come out. Now, what is the market really pricing in as far as risk, given the context of all this data that's coming out? We're going to talk about that in the expected moves section of this video. We're going to hop over here and just look at week to date, month to date, year to date performance very quickly on some of these index products. For this last week over here, the NASDAQ composite, pretty broad market, did good, right? Up 2%. Towards the bottom of the list, what do we have going down? 10-year yield, that backed off a little bit. We prepared for that quite well, in my opinion. That on my last video, we talked about that. And it's likely that these move hand in hand, right? Oil and the yields, right? When yields go down, typically is giving us indication, when oil goes down, it's typically giving us indication that the 10-year yield will follow there too as well. So other than that, SPY was up almost 2% on the week. DIA up about 1.5%. And then we had tech. This is going to be an important one to watch because month to date, they were up almost 10%. Qs, right? And then week to date was 1.94. So when we get to that expected move section, pay attention to where we stand within the quarterly expectations. And I'll give you some Goldman Sachs data too that they had brought up as well. Okay, if we take a look at the 11 sectors that make up the S&P 500, energy was towards the bottom of the list here. It was at the bottom and the only sector in the red. I think this is going to be an important sector to watch here in June. Remember, when energy outperforms the S&P 500, it's not really been a good sign for the S&P 500. And energy is strongly correlated to oil. And I'll show you an oil chart here momentarily. If we take a look at the 10-year yield, you can see this is the last time we talked about it on this kind of reversal candle over here. And since then, we came off a little bit, but ultimately, what are we doing? We came up, we bounced, we came down, we moved higher, and now we're pulling back. Are we just putting in a higher low to potentially keep, charting around, maybe go higher? Price momentum oscillator is starting to curl over. So if this drops, obviously we can look at bonds, but as it stands right now, it's looking like it's kind of just consolidating and pulling down. So I wouldn't be surprised to see this pop back up, maybe do 445, which is 4.5 on the 10-year yield, and kind of play it from that point. point. Now, what will make me even have more belief that that would be the case is if oil starts to break out of this kind of sideways price action over here. And the reason why I say that, this black line here is oil, is because the 10-year yield pretty much follows suit or shortly thereafter, as we've pointed out, many times, where oil, topped out here, started going down. Oil 10-year yields followed there shortly thereafter. We also had oil found a bottom right over here before going higher, and then the 10-year yield, you can see down here, found its low shortly thereafter before heading higher as well. So as oil's been kind of pulling down, the 10-year yield has been going up to right here, and we said, I think the 10-year yield is going to pull back here given the context of what oil has been doing. So now if oil starts to break out from this, I think that that would be the indication that the 10-year yield will probably follow. And if I'm looking at oil by itself, we'll look at WTIC. You can see we're just really consolidating. Now, it is in a bearish trend. We broke down. This was a pretty substantial breakdown of this area. So I'm not saying it's going to go to 80 or anything like that, but to see maybe it pop up into the 60s, maybe 70s, retest that 200-day, right at around in this kind of range in here. I think that that's a possible scenario that we need to be open to navigating. If we take a look at the S&P 500 on the weekly time frame, we had now 3 weeks disconnected from the weekly 5 EMA. It's a pretty rare occurrence. I think it happened, right over here. That was the most recent time that happened. And I went back and I couldn't quite find another time. It happened on a couple of occasions. I just can't remember right off the top of my mind. But you can see we had these 3 weeks, and then we, saw a big move or a rubber band type move here to reconnect with the weekly 5 EMA. So I would imagine we're going to probably reconnect with it, whether that's through time or through price. I'm not too sure. But if, we continue to head up higher, this is going to catch up. Perhaps we reconnect with it in a way like that. But right now, what are we doing? Well, we're just consolidating sideways. If we take a look at the SPY on the daily time frame, you're above a rising 20-day, you're above a rising 200-day moving average, you're above a 50-day moving average that's starting to turn around too. And we kind of just got pinned in around this shakeout area that we've been discussing going sideways. And I want to call out because there's actually an important level here. And that important level happened to be the month-to-date expected move from last month. So you can see here's the MTD. This is last month's expected move. This number, right? We didn't know at the end of the month. We knew this at the end of April for the month of May. And we put that on our chart, and you can see what did price do? We kind of went sideways, we gapped up to it, and we went above it, we went below it, we came back, and then we closed right there at that month-to-date implied move. So we'll update you on the new month-to-date move, and we'll revisit those quarter implied moves here momentarily. If we take a look at the Qs not too far. This one is positive on the year, and it's not too far from all-time highs, and this one's also been kind of consolidating sideways above some of those key averages. However, it's also above a critical level that we'll get into in the expected move section. IWN, it's kind of butting its head right up on this downward sloping trend line, and I'm feeling as if we might be able to see some price action occur. Maybe not specifically in IWM, maybe, right? But I think in some small cap names in various sectors and industries, if you start paying attention to some of these small caps, higher beta, liquid names, they might be some really good opportunities in there for the month of June. So we're going to continue to keep an eye on that. I'll probably have some show up in my tight list for those that are in the Patreon group or in the Discord there. But right now, what are we seeing? Well, price action's consolidating. It's getting tighter. I like that. It's at a trend line. So my thought simply is if we can start breaking out, this looks like a very possible situation to see 215 to 220 come into play for small caps. More importantly, we'll talk about the expected moves and what the market's pricing in as far as risk on those. But we're going to start here looking at the S&P 500. So right now, what you'll see on my screen, you see a couple of numbers down here. They're dashed thick and solid thin. The solid thin lines, it's giving you the upper and the lower expected move for the month June. Sorry, I was about to say April again. So 61.62 to the upside, 56.60 to the downside. Why is this important? Well, it's just like I told you, this was the month to date that we got at the beginning of April for the month of May. And was this important? If you knew this level, once we got above it, I mean, it seems to be important, right? So the market's pricing in risk, and it's telling you this is the risk that we are pricing in. Now, it doesn't mean it can't go way above it, way below it, whatever the case is, but that is what the market's pricing in. So these are its happy place up here. Now, that's also just slightly above the quarter to date expected move, which I'll give you that number here momentarily. To the downside, the lower level is 56.60, which would bring us right down here. And that would be basically a back test of this large hammer type candle, doji candle that put in this long lower tail. Okay, so we said there's the month to date. Let's go ahead and update that. This is what the new month to date levels look like on the SPY. That's 614.28 to the upside, 564 to the downside. Now, this is a much smaller expected move than the prior month. So the market's basically saying here, hey, we saw larger volatility last month. That's what we were pricing in. This month, we're pricing in a little bit less volatility. So is that, are they going to be wrong? Are they going to be right? I don't know yet. I couldn't tell you, but right now that is what the market's pricing in. Now, if we come down to these levels, pay attention to this higher low, this VWAP we've been kind of tracking because we have yet to test it. And I feel like this, if we get some sort of shakeout move and it comes up higher, right, this would be a very critical level to kind of key in on for the month of June if we start to see some weakness in the S&P 500. Above us, right, 614.28, and this is the quarter to date expected move. Now, another interesting thing here is the quarter started, right here, right around here on April, sorry. Okay, we have one more month left in the quarter. And what happened? Well, we got a massive shot of volatility that expanded way down to the quarter to date expected move. This is where all the fear rose, everyone was going crazy, but we priced in the weekly implied move and it was well within its expectations for the week. It was just getting to a place under a quarter expected that we said, hey, these are typically the times that longer term investors come in. They say, if it happens this quick, I'm going to be taking advantage of this and adding a little bit more to my portfolio or whatever the case is. So we came down here, we shot back up, and now we're darn near at the upper ranges of the higher quarterly expected move. So just a massive comeback in a very short period of time. If we take a look at the SPY on the 15-minute time frame, you just get some more intricate price action of how we've been kind of going sideways. The 5-day moving average is flipping up. This gray line here is last year's closing price. We're above that right now for the SPY. Now below us, you can see this lower month-to-date expected move, the one that we just went over. Take a look where it lines up with. It lines up with this low right over here, which happens to be the gap that was kind of open and left. So when we talk about, hey, if price were to come down here into this VWAP or this month-to-date implied move, to be prepared because there's multiple levels of confluence down here that if we start to break back from it, it could produce a good buy the dip opportunity for those that are bullish. For those that are bullish but patient, you want to wait for the 5-day moving average to start turning back around. Now, if we start to continue to break up higher, we have the upper weekly implied move at 600. I'm just going to round it. We have the lower implied move at 578. I'm just rounding it. And then, like I said, we have these quarterly and monthly here. If for whatever reason we get a massive move early on in the month, be aware of creeping up into this higher range. Yes, it's coming into the month to date, but a lot of the times we'll doodle back in within the quarter, very similar to what we saw right over here. Okay, we'll continue on and look at the Qs. Now, the Qs are holding the largest market cap names, the ones that have the weight in the S&P 500, right? The Mag 7 stocks. The reason why I said I want you to pay attention to the Qs here is because we're actually outside of the quarter to date expected move right now, right? We got above it and then we came kind of back into it. So what happens if the Qs kind of just stick around here for the remainder of this quarter? That could put up more pause, more shakeout into the S&P 500. So I think we got to just be prepared for where money wants to flow to if it's not going to be the Mag 7. And that kind of came to my point was maybe some of these small caps, right? If the market's going to go, growthy, or potentially higher beta names and momentum names, we might be able to find some names in the small cap field to potentially play. Now, if you take a look here, the Mag 7, the MAGs, right? ETF just had its best month ever. And that just goes to show you, right? It was a huge, huge move here this last month in the Qs, and then the ones that focus in on the MAGs saw a big move. Now, this was an interesting note from Goldman Sachs. This black line here that you're seeing is the NASDAQ 100. And basically, they're just showing you a bunch of years from 2010 up to 2024, and obviously where we're at 2025. And they basically made the note saying that they suggest, because of where we stand from a year-to-date basis, from other times that we were in this area, it was likely to see more chop and flat range-bound type markets in the NASDAQ. So I thought that was an interesting note. I thought I'd bring it to your attention. As far as the IWM goes and its implied moves, you can see the upper monthly is at 216. The lower monthly is at 193. And then you have the dashed thick lines, which is the quarter. You can see that we kind of went way, way, way down into a bear market territory here. And we made a pretty snappy recovery and we had some follow through. So the kind of that 215 to 220 range, if IWM wants to break from that trend, this would be the level of resistance or potential resistance that I'd say keep an eye on, that 215 to 220 in this specific ETF. Let's go ahead now and take a look at the current market conditions. For the market conditions, there's two things I like to really kind of hone in on, and that's the directions of the 5-day moving average and then where we stand within the gamma flip line. Very quickly, when I look at this right now, it's a lot of chop. So I'm going to just call this from this perspective on SPY, Q, IWM, DIA, XBI, semiconductors, neutral. neutral, right? We're seeing a bunch of red, green, flat 5-day moving averages. So there's no real trend. I'm calling it neutral. If we take a look at where we stand within the gamma flip line, we're right above it. So we're in positive gamma. And what does this mean to you and to individual traders and so forth? When we're in positive gamma, from my experience, this tends to be better for swing traders. The reason why is because dealers look to sell the rip, buy the dip, sell the rip, buy the dip. Okay, that's what brings volatility down and liquidity increases. However, when we're below the gamma flip line, when we start to break from it, this is where dealers start to sell into selling, buy into buying, liquidity dries up, and volatility increases. And that's where you get very, very big moves. That environment tends to work a lot better for day traders or shorter term traders. So I have a strategy for swing trading when we're in negative gamma. I have a strategy for when we're above a flip line for swing trading. And then I have a process where I go into more of a day trading mindset when we're more gamma neutral and negative gamma, which is something that I've been doing. Now you might be saying, well, show me the proof. I've shown this many times. This is a time history chart of being in positive gamma and or negative gamma. And you can see this period right here from February 21st to just recently was all negative gamma. And I've highlighted this on the VIX chart to show you what it actually looks like and what it could potentially do to prepare you for getting into an environment with elevated volatility. So these gray boxes are showing the times that we've been in negative gamma. So for example, right over here in February, we started going into negative gamma, and imagine being able to know not necessarily where the VIX could go, but being prepared for the potential for the VIX to spike like this in multiple instances, what you would be able to do knowing that data or having that information in your back pocket, which I found incredibly valuable. A lot of people, I want to focus on this. A lot of people, they'll go from strategy to strategy to strategy to indicator to indicator to indicator. And what they don't realize is they're like, this strategy works really good. And then all of a sudden, oh, this month is really hard to trade. They're doing the same strategy, the same element, not quite coming to the understanding that one strategy does not work in all market environments. So to understand where your strategy works best in what conditions will elevate your game tremendously. Okay, let's continue on. Right now, if we're looking at the VIX curve, okay, this is the VIX futures curve. It's in contango. This is good. You don't want it in backwardation. It tells us that, hey, everything's cool now, but when we look out into the future, yeah, we're going to see an elevated VIX. Now, overall, this is kind of flat, right? So if you're looking at the VIX futures right here, it's at 2105. Then way out here is 2175, or we'll just go a couple of months, right? 21.6. So it's not like a huge contango by any means. And we're still rather elevated in this current market, which means what? It means that if we remain above the gamma flip line, volatility could come in. However, why would volatility be high right now? And I think that just goes to what we've been talking about earlier as far as uncertainty in the market. When there's a lot of more uncertainty, when we don't know what's going to hit the tape, there tends to be kind of an average of a higher volatility that we need to be aware of. If we take a look at back month versus front month volatility, we've been coming up here a little bit, but we're by no means elevated at that 20% level, which is typically where the market starts to base out and pull back in, but we're not too far from it. So we got to just continue to monitor that. If we look at CTAs, you can see we're flipping above that zero line. They've been buyers here. We've been preparing for the turn in CTAs, and it benefited us if you were prepared and you played into this rally and you kind of put aside all the fears and the fear mongering and all that good stuff, right? I think it's important to understand risks, but I think it's more important to have a plan for if you're wrong about those risks, right? So it's always, when you're trading, swing trading, it's if this happens, then I'm going to do this. And a scenario for both bearish and bullish cases. If we take a look at some signal charts, we were talking about how, be more careful when we start to get a put to call ratio, 10-day moving average below 8 or 0.8, I should say, because this is where markets can pull back, where they can consolidate. And what have we been doing since we crossed down through this? We've been consolidating, going sideways, a lot of chop as this is starting to elevate into an area that's not rather extended. It's seemingly more neutral now. It's not like an extreme bearish or bullish sentiment, I should say. If we look at the old fool indicator, which looks at the CPC, but we're actually taking the NASDAQ composite and dividing it into it and then applying some moving averages to smooth the data. When you start to get moving average crossovers, albeit this is a very lagging indicator, but it has gotten us on the right side of trend, so I continue to watch it. Over here is a bearish crossover, and we led to some pretty significant sell side. Over here, we had a bullish crossover, and it led to a nice rip there in the markets, and we still remain in that kind of bias environment, albeit once again, it is a lagging indicator. So, it's not to put all your eggs in this basket. If we take a look at the bullish percent chart for the technology sector, this one's been coming off. As it's been coming off, the tech stocks have been just consolidating here sideways. When you get, through 75 through 70 and it comes in, maybe we can see a little bit more significant sell side, but it's holding up rather well as the RSI is coming off and then price actions just consolidating. So tech is holding up as it stands. A couple cool divergences that I'm continuing to monitor. Housing market up here, S&P 500 down here. And you don't want these divergences in these markets to hold for long because of just how important the housing market is. And you can see here, the housing market had matching highs while the S&P 500 went higher. And guess what? That led into the bear market of 2022. And actually over here at the bottom, you can see that we put in a low and a higher low in the housing market. And that actually was a divergent from the S&P 500, which it was a bullish divergence, which led us into this market rally. And if you go back to 2005, the housing market actually topped in 2005 while the S&P 500 continued to run. So the housing market has been a leading indicator for what could potentially take place in the S&P 500. And the reason why I'm bringing it up now is because more recently we talked about how housing market was breaking down while the S&P 500 was pressing higher, and how that could be, a negative sign. While the S&P 500 sunk off, the housing market sunk off, and now we're seeing a pretty sharp V recovery in the S&P 500. But what I'm paying attention to here is housing market is not participating. So is it going to all of a sudden pick back up here in the near future and start to catch up? Perhaps. And if it does, watch still potentially if the S&P 500 puts a new high, but this one does not, that could lead us into potentially more weakness. Who knows, 5-6 months down the road. Okay, so I thought that was interesting. Also, value line geometric index versus the S&P 500, so like an equal weight index. When this one puts in lower highs, I'm highlighting it in these yellow boxes, but the market presses higher. This is also something to just be mindful of. It's telling us that from an equal weight perspective, things aren't doing as good. So only few names are driving this cap weighted index up, the S&P 500, and it's telling us that the internals are weakening. You can see over here, we have the divergence, right? Breaking to new lows here, but yet the S&P 500 pressed to new highs, and it led to what? Sell side, like it did multiple times. Now, the reason I'm showing this now is because we don't have a divergence, but we do have this kind of just sloping down here like this, flagging out. This one's kind of sloping down too. So if we're going to start to see the market move higher, you'd want to see equal weight, right, start to pick up somewhat more of a bid than it's currently doing here to break higher. If we take a look at the 5, 10, 20 timer, this is looking at the 5, 10, 20 EMAs, and you can see we have the blue line above the red, above the green, which means the 5 is above the 10, which is above the 20. So the trend is currently up. It's if you start to stack them negatively and they start to cross underneath each other, and they're, it's 5 is under the 10, 10 is under the 20. That is the more of the sell side, the more cautious sign to be aware of. And we add this buy signal flip over, obviously it's once again a lagging indicator, but nonetheless, right, this was where it originally initiated, and we've been doing good thus far and still remaining in a bullish trend. That's for the NASDAQ composite. For the SP 500, same situation. You can see they're all kind of holding up here, with holding also the larger one of this average of the 20-day that is sloping up. All right, let's take a look at the crypto market. Cryptos kind of came in a little bit and it's freaking people out about a trend line that broke. Overall, the sailor to shift tool, we are still above the 0 line. There is no official sell signal and or sell trigger based off of the model that I put together. And you can see here, since the original buy signal, buy trigger, the market's moved from roughly about 95,000 range up to and around 112. So a nice catch there, or maybe it was a little bit lower. Or was it this? I can't remember exactly. Maybe it was like high 87. I don't exactly remember where it triggered, but needless to say, we saw a nice big move. Now it's slowing down a bit over here, but still remains above the 0 line on that rate of change. We can zoom in. You can see it a little bit clearer over here. Right now, we have an inside trading week as we press into new all-high territory. Go figure, the market was up, multiple weeks in a row, and what is it going to pull back? Is that bearish? Does that mean the world is going to collapse here and crypto's going to 0? Like, I don't really put my hat on that too much. I wouldn't make that bet, but to see some consolidation and pullback, sure. lower and then be more cautious if we actually get an official sell trigger, which I'll be talking about here on the show if it does occur. If we take a look at Bitcoin here on the daily time frame, you can see this trend line, which we talked about last time. We saw a big break from it, consolidated, break from it, consolidated, break from it, consolidated, break from it, and now it consolidated and then broke down from this trend. This type of trend, right, this steep trend right here, these don't hold. Once they break, you typically go through consolidations. I mean, look at this one right here, right? We went up super fast and then it went sideways for quite some time and eventually resolved lower to going sideways to break up higher. Okay, so all I'm seeing here is just a pullback consolidation, nothing to be overly too crazy about until we start to get some other, obviously, signals that tell us otherwise. If we take a look at gold, you see here also a strong move, 3 lower highs as it stands. Some people might call this a flag. I hate seeing these, aggressive 3 lower highs. And so to me, this looks like it can break lower, but I'm not really willing to risk a lot of money thinking that this can go lower. I did take, because somebody on X said, why don't you just short it? Then I said, okay, sure, I'll short gold. So I bought ticker, I think GLL, which is like a leverage short gold fund, but I did like 75 basis points or 100 basis points just to track it over the course of time. Because if it breaks out, obviously I don't want a huge position or a full size position. By the way, for those that don't know, when I take a short position, which is rare, it's at max 1/2 the size of my full size of my long. And the short that I took in here is not even half size, so it's just something to track. But I did find this also interesting too. If you look at silver's been consolidating sideways. It doesn't necessarily look bearish, but if silver breaks down too, because silver hasn't really moved with gold, which is kind of a bummer to those people that that believe that silver correlates really strong with gold. That really hasn't been the case. And one of the things that I've been saying is if you want more, if you're bullish silver and you want more leverage that's also connected to gold, I'd say pay attention to miners, because GDX versus silver, just take a look at the correlation here from a 20-day perspective. It's like perfect correlation darn near all the time. And what I do find interesting here is if silver were to break down, it had a down day, 1% the other day, really just going sideways, but gold miners happen to be up. So if silver breaks down, this is a positive correlation, but miners are still holding up. I'd probably actually look to short gold miners too, because silver would be telling me that, hey, something's off here given this correlation, because silver tends to be the one that can lead and show the strength. So if silver breaks down, I just don't see how gold miners can really hold up. And this little tool here and this correlation is how I've actually shorted gold miners multiple times. But typically, like I said, it's more quickly done and it's with not a lot of risk, because it's just not my style. If we take a look at Ethereum, this one looks pretty good too. We broke through this trend line, consolidated sideways, broke up, and now we're just consolidating sideways here and flagging right around that 200-day moving average. So if we can start breaking through this level, this can move fast. We can quick hit to 3,000, 3,200, 3,400, come retest this area over here. So I think that is a big possibility here in June. If we start breaking down, the Sailor Shift tool starts to flip negative, cool, give it some more time, right? It's simple as that. What I love most about consolidations is when you're going to be wrong and when you're right? So if it breaks down, what do? Like hope and pray that it comes back? No, you get out, you wait for it to turn back up, and then you start to play the breakout again. And if it goes, cool. If it doesn't, cool, you get out. You manage the risk in these tight little pockets, because the goal here, for me at least, for swing trading, I'm looking to get my money in and out fairly quickly, at least the bulk of the trade, and to make the most I can return on my capital in the shortest amount of time, right? Because things contract and then they expand, and with as little risk as possible, right? So make the most amount of money in the shortest amount of time with a little least amount of risk. That's what I do. All right, so those are the things I'm looking at. I wanted to hop into some ETFs to watch now, because this video is getting a little bit longer than I wanted. And I'm not recommending these ETFs, but maybe if you have some time, you can look up the holdings and see what what's inside of them maybe, and maybe you can find some good trade ideas by doing so. But these show up on my radar, so I figured I'd share them here. First and foremost is SPMO. This is actually momentum ETF for S&P 500, and I think this looks good. We're at basically highs right here. We've been consolidating sideways, so maybe look at some of these momentum names, because this could be, if momentum continues, right, these could be the area where investors look. So momentum, right? So SPMO, that's an ETF, pull up the holdings and so forth. BITS, BITS, this is just global X blockchain and Bitcoin strategy. You can look at, BIDO, ETHE, right? ETH, but I just figured I'm putting this one on here because it's a higher beta name. This one's pretty low volume. So, I would look for various maybe crypto equities and holdings that are in it, given the context of what we just talked about in the crypto section. But yeah, we're breaking down here a little bit. We pull back, but if we are going to see some uptick in some of these higher beta names and crypto is going to start to pick, these could be an area to kind of look for. This is a disruptive technologies ETF called DTEC, DTEC. And this thing looks really good too. Once again, lower volume name. So look at the holdings of the individual stocks and maybe you can get some sort of ideas here, but we're near all-time highs and price action also is just consolidating and getting tight right here too as well. Okay. If we take a look at another one, which this is like the innovations ETF ARC. I'm just showing you this because it's kind of within that same category. So you can look at stuff here too. But this one's just flagging. This was on my radar actually on this day over here where we started talking about the potential for kind of this inverse head and shoulders. And I was marking it out down here and immediately then after saw a nice big pop. And now we're just getting a nice sideways consolidation above some key averages. If it breaks down, okay, just let it come back up and then look to re-enter if it makes sense to, right? If it starts to consolidate and set back up. But don't just hold things blindly if it's selling off on you. So always have an idea for risk entering any name. Cyber, CIBR, this is a NASDAQ cybersecurity ETF. This thing is pressing new highs right here, consolidating sideways. Not a bad look either. So look at what's in there. Hack, this is also a cybersecurity ETF. So I'm just showing you multiples of them. Also kind of going sideways here near these highs. Also not a bad look overall. Heal, this is actually health technology, like more of like an AI play in healthcare. I don't necessarily think that healthcare is going to be the greatest trade right here, but maybe if you look into some of their holdings and look at like maybe AI related healthcare names, healthcare tech names, that could be something potentially positive here. And we're just kind of consolidating in this ETF, which is also a lower liquidity type name, but we're kind of consolidating sideways here. And if we start breaking out, I mean, that could be a potentially good little pop there. My eyes are starting to hurt right now. AIQ, this is an artificial intelligence and technology ETF. And this one too, just nice sideways consolidation like a lot of the stuff that we're seeing. So maybe pull up the holding, see if you generate any new trade ideas, seeing some tight price action there. And then the last one is IJR. Now we showed IWM, but IJR is just another one that is in the kind of small cap space. And it looks pretty much just like IWM, but I figured I'd give some different options there. You can pull them up, see what the holdings look like and so forth. But price action's kind of settling here underneath this big trend line and could produce a nice move on a breakout. And, if it doesn't break out, once again, who cares, right? You're not trying to risk everything that you have on one single trade, but you do want to be a part of it on names that do move higher. And that's the ultimate goal, is to look for low risk, potentially high reward setups that can happen very quickly. That's all I got for you in today's video, everybody. Hope it helps out. I'll see you on the next.